Stop being fooled by fake signals. Most traders just blindly use classic indicators without building logical connections between them. Today's compound cross-confirmation system will completely change how you think about multiple indicators and teach you the true way of indicator synergy. Hello, trading enthusiasts. Welcome to the Inventor's Strategy Selection channel. Let's face a harsh reality. 90% of traders suffer from indicator false signals. Have you experienced this? RSI shows oversold. You excitedly enter, but prices keep falling. Stochastic shows a golden cross. You chase the rise, only to face an immediate pullback. Even worse, when you try using multiple indicators together, you often face contradictions. RSI looks bullish, but Stochastic looks bearish. Who should you listen to? This is the fatal weakness of traditional single indicator trading and incorrect multiple indicator usage. A single indicator is easily disturbed by market noise, producing many false signals, while most people's multiple indicator approach, simple stacking, misses real opportunities or causes analysis paralysis. In oscillating markets, these problems become worse as indicators frequently send conflicting signals, leaving traders confused. Today's compound cross-confirmation trading system is designed to completely solve these pain points. It's not a simple combination of multiple indicators, but a complete multidimensional signal confirmation mechanism, specifically optimized for oscillating market environments, giving classic indicators new life. Now let's dive into the core logical architecture of the compound cross-confirmation system. This strategy's key breakthrough is building a hierarchical relationship between indicators rather than a parallel relationship, completely overturning traditional multi-indicator thinking. First layer, price strength dynamic monitoring system. We've designed a mechanism to track the direction of change in relative price strength, not just static values. This system continuously monitors inflection point signals of strength changes, avoiding false signals during sideways consolidation. Second layer, short-term momentum cross-confirmation mechanism. By monitoring short-term momentum indicator crossovers, we get momentum verification signals. The key innovation is that we don't simply require all indicators to be bullish or bearish simultaneously, but require them to send effective signals within their own logical frameworks. Third layer, dynamic dual-line crossover system. This is the core innovation. We use the price strength indicator itself as the fast line, and its smooth result as the slow line, creating a new dual-line oscillator structure. When the strength indicator crosses above its smooth line at the right position, it shows that upward momentum is gathering even in relatively weak areas, providing deep momentum information that traditional single indicators cannot. Fourth layer, position constraint mechanism. We set strict position constraint conditions ensuring that only signal crossovers at appropriate technical positions are considered valid. For example, upward crossovers are technically meaningful only when the price strength indicator is at relatively low levels. The complete logic chain for buy signals is price strength rising plus appropriate position, plus short-term momentum reversal confirmation plus momentum acceleration signal confirmation. These four levels form a complete market state description, quantifying complex market turning points into clear technical conditions. Sell signals use a completely symmetrical but opposite logic structure. This design allows us to capture subtle momentum changes before traditional indicators signal, while greatly improving signal reliability through multiple verification mechanisms. This is the essential difference between professional and amateur trading, not using more indicators, but making indicators work together more intelligently. Let's analyze the logic and technical meaning behind each parameter. First, the RSI indicator group. RSI period is set to 14, a classic setting that effectively balances response speed and stability. The data source uses the average of 4 prices, which provides a more comprehensive reflection of price behavior compared to just closing price, reducing the impact of single price point randomness. The key innovation is in the buy-sell line settings. RSI buy line is 35, and sell line is 65, significantly different from the traditional 30 and 70. Why? Traditional 30-70 lines often lead to late entries. When RSI reaches 30, downward momentum may be largely exhausted, while entering at 35 allows earlier capture of reversal opportunities. Similarly, the 65 line is more conservative than 70, avoiding the risk of chasing highs in the late stages of uptrends. The RSI smoothing system parameter is also set to 14 periods, which isn't coincidental, but carefully designed. The same period ensures RSI and its smoothing line maintain synchronized market rhythm, giving crossovers more pure technical significance. The moving average type offers 5 choices. An important design that allows selection of different smoothing methods for different market environments. For the stochastic parameters, the K period of 14 coordinates with RSI period, while K smoothing and D smoothing are both set to 3, providing double smoothing to effectively filter high-frequency noise. The stochastic buy line is set to 20 and sell line to 80, more conservative than standard settings. In a multiple confirmation system, each component needs stricter triggering conditions. Finally, the RSI and moving average crossover buy line is set to 40 and sell line to 60. These parameters control the effective zones for RSI and smoothing line crossovers, ensuring only crossovers at appropriate technical positions are recognized as valid signals, a rare refinement in traditional indicator applications. Now let's analyze the definition and calculation logic of core indicators. First, the RSI calculation is standard, measuring relative price strength. The basic principle of RSI compares the ratio of upward and downward movements over a period, with readings below 30 typically considered oversold and above 70 overbought. However, traditional RSI has an important flaw. It only tells us the current overbought or oversold state, but can't judge the trend of this state. Next is the strategy's first key innovation: the moving average function design. This function provides 5 different moving average algorithms to smooth RSI, each with unique characteristics. Simple moving average gives equal weight to all data points, providing the most stable smoothing effect. Exponential moving average gives higher weight to recent data, responding faster. Weighted moving average uses linearly increasing weight distribution. Smoothed moving average provides the strongest smoothing effect. Volume-weighted moving average incorporates volume information, giving higher weight during high-volume periods. This flexibility allows the strategy to adapt to markets with different volatility characteristics. The smoothed RSI calculation implements the core innovation, applying moving average processing to RSI itself, creating an RSI moving average line. This gives us 2 lines, the original RSI and the smooth RSI. We build these into a dual line structure similar to MAC-EC. This design provides momentum direction information that traditional single RSI cannot, an important extension of classic technical indicators. The stochastic indicator part uses double smoothing processing. The principle of the stochastic indicator is to compare the closing price's position within the high-low range over a certain period, reflecting the relative position of price. Here, double smoothing is used, first smoothing the original K value to get the %K line, then smoothing the K line to get the %D line. Now let's deeply analyze the design logic of strategy conditions, the intelligent core of the entire system. Let's examine the meaning and function of each condition variable. First, the stochastic indicator crossover judgment. Bullish crossover detects when %K line crosses above %D line, a classic stochastic bullish signal, typically indicating short-term momentum beginning to strengthen. Bearish crossover detects the opposite, when %K crosses below %D, indicating weakening short-term momentum. These conditions provide confirmation signals for short-term momentum changes. Next is RSI momentum direction judgment. RSI rising and RSI falling. Note the key innovation here. We're not simply looking at RSI's absolute value but focusing on RSI's direction of change. RSI trend detects whether RSI is rising or falling. This dynamic tracking avoids ineffective signals when RSI moves sideways, only triggering subsequent judgments when RSI shows clear directionality. Now for the most core innovation, the crossover relationship between RSI and its smoothing line. RSI crossing above the smoothing line requires 2 levels. First, detecting RSI crossing above its moving average, indicating accelerating upward momentum in RSI. Second, ensuring this crossover occurs at relatively low levels, with RSI below RSI SMA byline, as only crossovers at appropriate positions have technical significance. Similarly, RSI crossing below the smoothing line requires RSI to cross below its smoothing line, while at relatively high levels, with RSI above RSI SMA sell line. What's the deeper logic of this design? If RSI crosses its smoothing line in the neutral zone, say between 45 and 55, the technical significance is limited because the market is neither overbought nor oversold. Only crossovers in overbought or oversold zones represent true momentum transition signals. Innovation highlights: first, dynamic direction judgment replaces static value comparison. Second, the dual line crossover system provides momentum acceleration signals. Third, position constraints ensure signal technical validity. The combination of these 3 levels builds a signal recognition mechanism that is both sensitive and reliable. Now let's analyze the strategy execution logic to see how multiple conditions integrate into final trading decisions. The buy signal includes 5 conditions that must be met simultaneously. Let's analyze each one. First condition, RSI rising ensures RSI is in an uptrend, providing basic momentum direction confirmation. Second condition, RSI below buy line, ensures current RSI is at relatively low levels, avoiding chasing highs. Third condition, bullish crossover, requires stochastic %K line to cross above %D line, providing short-term momentum reversal confirmation. Fourth condition, stochastic K value below buy line, Stoch buy line, ensures stochastic crossover happens in the low region, enhancing signal reliability. Fifth condition, RSI crossing above its smoothing line, requires RSI to cross above its moving average, while at relatively low levels, the key signal for momentum acceleration. These 5 conditions form a complete market state description. In the oversold area, when both short and medium-term momentum begin to reverse, and RSI shows accelerating upward signals, a high probability reversal opportunity forms. The sell signal uses completely symmetrical logic. RSI falling ensures downward RSI trend. RSI above sell line ensures it's at high levels. Bearish crossover confirms short-term momentum reversal. Stochastic K value above sell line ensures crossover happens at high levels. RSI crossing below smoothing line confirms RSI momentum accelerating downward. The execution part uses strategy entry functions. When buy signals trigger, long positions are entered. When sell signals trigger, short positions are entered. Note the design philosophy. The strategy uses direct entry, executing immediately once all conditions are met, showing high trust in the multiple confirmation mechanism. The strategy also uses reverse signals to close positions, closing long positions when sell signals appear, and closing short positions when buy signals appear. This design avoids complex stop-loss and take-profit settings, letting trends fully develop. Innovation summary. This strict multiple condition combination quantifies complex market turning points into clear technical standards, achieving the optimal balance between signal quality and execution efficiency. The visualization design reflects professional traders' practical wisdom. During signal development stages, all core technical indicators, RSI, smoothed RSI, and stochastic, are plotted. Once trading signals trigger, green up arrows labeled buy appear on the chart, while sell signals display red down arrows labeled sell. This clean visual design lets traders instantly identify key opportunities, avoiding distraction by technical details at crucial moments. Through the alert condition function, the strategy can immediately send notifications when multiple confirmation conditions are met, freeing traders from continuous market monitoring. The compound cross-confirmation system's value lies in solving the core challenge of using multiple indicators, how to make them work together rather than interfere with each other. In oscillating markets, this strategy shows excellent performance because its multi-layer confirmation mechanism effectively identifies high-quality reversal points within oscillation ranges. Traditional single indicators tend to produce too many signals in oscillating environments, while simple multi-indicator stacking often misses opportunities. This strategy achieves the optimal balance between signal quality and capturability by building logical hierarchical relationships between indicators. However, understanding the strategy's limitations is equally important. In the early stages of strong trends, the strict requirements of multiple confirmation mechanisms may lead to relatively delayed entry timing. This is an inevitable result of the design philosophy. We pursue high win rates rather than high frequency. The key to professional application is market environment recognition. Actively use this strategy when the market is judged to be oscillating. When the market shows strong trend characteristics, use it cautiously or combine it with trend-following tools. Advanced application techniques include combining larger timeframe trend analysis, only looking for opportunities in the main trend direction. Using volume confirmation, reliability significantly improves when signals are accompanied by volume expansion. Fine-tuning parameters based on different instruments' volatility characteristics. Mastering the essence of this strategy has important value for understanding professional multiple indicator usage methods. Based on professional trading system evaluation standards, the compound cross-confirmation system shows excellent performance across multiple dimensions. Innovation is its most outstanding advantage, scoring 4.5 by building a dual-line system with RSI and its moving average. It extends a single oscillator into a tool with directional judgment capability, an approach with important technical analysis value. Understandability scores 4.2. Despite using complex multiple confirmation logic, each component's technical meaning is clear. Condition settings are logical and transparent, providing an excellent example for traders learning the correct use of multiple indicators. Practicality scores 3.9. The strategy provides high-quality, but moderately frequent trading signals, particularly suitable for mature traders pursuing trading quality, while providing valuable reference for beginners to understand professional trading system design thinking. Strategy completeness scores 3.8. The multiple confirmation mechanism builds a complete signal generation framework, but there is room for improvement in risk management, lacking comprehensive stop-loss and position management rules. Adaptability scores 3.5, showing excellence in oscillating markets, but with certain limitations in strong trend environments, an inevitable result of its design philosophy. Risk management scores 3.6. Multiple confirmation itself is a risk control mechanism, but over-reliance on reverse signals for closing positions seems somewhat simplistic. Overall rating is 3.9. This is a strategy framework with important educational value and practical reference significance, its core contribution being demonstrating how to correctly build synergistic mechanisms for multiple indicators, important for understanding professional trading system design.